Hi, all. I hope you're having a great day. Thanks for joining me today for the chapters 7 and 8. We're going to be going over those. And these are kind of a summary, overview type of instruction rather than a total comprehensive, um, you know, in detail learning uh, opportunity. So keep that in mind that I'm not going to cover absolutely everything. I'm going to cover what I feel like you need to be successful as a tax preparer for Jackson Hewitt. Okay, anything that's more complex, more detailed, you're going to have senior preparers that are able to help you through anything that you run across. So if there's some more detailed stuff in here that you're concerned about, don't worry about it. We will take very good care of you. Okay, so let's get right into it. So we're looking at interest and dividends. Okay, so the objectives here of this one are to apply the correct tax treatment to the amounts that may be included on a 1099 INT form. That's the interest income. 1099 DIV form is dividends and distributions. And then we also are going to be looking at a 1099R, which is a pension or retirement plan income. Okay, so it's going to talk about the Schedule B, but that stuff is all taken care of by the tax software profiler. So don't worry too much about actually figuring any of these amounts. I'm more concerned about you guys knowing what you're looking at when you get one of these forms. Okay, so interest income. Taxpayers receive interest income when they lend money to a financial institution, a corporation, government, or individual. Okay, so this is mostly what you'll see for interest income is going to be something from like bank savings accounts or uh, credit unions call it dividends, but really it's just interest that they pay to their members. Okay, and there's taxable and there's tax exempt interest. Um, Tax exempt interest comes into play when you're talking about government, like bonds and that kind of thing. So there are, if you, there are two different kinds of bonds. Well, three really. There are local municipal bonds. There are state uh, bonds, and there are federal bonds. Okay, and they're all treated differently for tax purposes. But that's you don't run across it very often. It is definitely out there, but mostly you're going to be dealing with 1099 INT forms when it comes to interest. Well, they all have 1099 INT forms, but the information that's on the 1099 INT form, when you put it into profiler, it will determine the tax treatment. Okay, so, but you do have to know it to get through the assessments for this exam or for this course. All right, so like I said, there's taxable and there's tax exempt. Okay, so right here it says tax exempt generated when a taxpayer lends money to government agencies. Okay, so like I said, it's local, state, or federal. All right, interest income is reported in the tax year that the taxpayer has received the income. Okay, this is going to talk about different types of interest. Okay, there are bank interest, municipal funds, or excuse me, mutual funds and dividends, and they can all be treated a little bit differently for tax purposes. Again, that is going to all come down to the information that's on the 1099 INT form, and then Profiler will determine the tax treatment for it. So this one goes over the taxable types of interest. Okay, so they're just listed out here. There are several different kinds, as you can see. And then it talks about government bonds or treasury obligations here. Okay. And these are a little bit confusing. So a, uh, a federal, a federal bond or bill or what have you is taxable, excuse me, is not taxable at the state level. Okay. So the state cannot charge you interest, charge you tax on the interest you received on a federal bond. Okay. the opposite is true when it comes to like a state or municipal bond. The federal cannot charge you tax on that interest. Okay, so it's a little backwards than what you might think, but it, just remember that if it's federal, it's not taxed at the state, and if it's state, it's not taxed at the federal. Okay, so hopefully that is somewhat clear for you. So it talks about treasury bills and how they're discounted, and that's way beyond the information that we need here. Okay, so I left it in, but probably should have deleted it out. Okay, so this talks about treasury notes and bonds and how they work. Um, Again, that's not pertinent to what we need to learn about here. This talks about different types of bonds, and probably somewhere here it's going to say that it's not when it's taxable and when it's not taxable. Okay, but this is just going over many different kinds of bonds, and honestly, it's not uh, it's not necessary to know. Okay, so um, this is a knowledge check that isn't going to impact you as far as your tax preparation goes, but federal for federal purposes, which transaction is not taxable? And you've got several options here. So a T bill that has not matured yet is not taxable. Okay, that's something that you won't ever have to know during tax preparation. Okay, but it's there. So a taxpayer must report as taxable interest on their federal return. So here it's mentioning um, municipal bonds, the Roth IRA earnings, backup withholdings, and gifts from a bank. So it's kind of municipal bonds are never taxable at the federal level. Okay, Roth IRA earnings aren't either. Backup withholding is just withholding that, well, there's no interest on it, so it's kind of a trick answer. And gifts from the bank is the correct answer. Okay, so gifts from bank, like if they give you, $100 to um, open up a savings account or something like that, would be a taxable gift. Okay, which which interest is taxable? The federal, but not taxable on the state return. So on this one, it would be like I said before. U.S. savings bonds are a federal uh, implement, and so they can't be taxed at the state level. Okay, so interest received on a Series EE bond, no one is going to ask you that. Um, it is reported when received or matured. Okay, um, this is actually showing. This is the 1040 form that it's showing here, and just showing where some of this information goes. But this is all handled for you by Profiler. Okay. All right, so it's talking about state and local. So that would be state and municipal bonds, generally speaking. And so those are the ones that are not taxable at the federal level. And it just talks about who the issuers are um, and uh, how they're treated. Okay. Now we're getting into IRAs. Okay, IRAs are individual retirement arrangements. Okay, they are for each individual. So if you have a married couple filing jointly, they're treated separately. Okay, they're not together on the tax return, or I guess maybe better put, each person would have their own. Okay, so uh, uh, spouse and the taxpayer cannot have one IRA account together. Okay, they would each have their own separate one. Um, There are two different kinds. There are traditional IRAs and then there are Roth IRAs, and we'll go into some of the differences here coming up. Okay, um, the interest uh, the interest statement is called the 1099 INT form. Okay, and they are the interest payers are required to give it to the interest earner, the client, when there's interest earned in excess of $10. Okay, so that doesn't mean that it's not anything under $10 is not taxable. That's not true. It's just that the agency or um, the payer of the interest does not have to issue a 1099 form, INT form for anything less than $10. Okay, and this information does have to be provided by the interest payer by January 31st of the following tax year. Okay, in order for people to do their taxes. So this talks about where you find the information on the 1099 INT form and then where it ends up going on the 1040. Okay. I'm not too concerned about, especially the 1040 line, because it's all done by Profiler. But here's a look at a 1099 INT form. Okay, so we've got the interest income is listed up here in box 1. Then we've got, you know, interest on a U.S. savings bond in box 3, and you've got tax exempt interest listed in box 8. So it's really straightforward. Um, to let you know where the interest is coming from, what kind of interest it is, and that kind of leads you to understand the tax treatment of it. However, the information is all handled in Profiler. So then this next slide is kind of like an illustration. It shows you some examples. I'm not going to go through that in too much detail because when you put it into Profiler, it all just is, handled automatically. All right, so which of the following statements is true? Um, Tax exempt interest is included in the federal AGI. No, that's not true. Interest on bonds issued by a state is taxable to federal return. That's not true because state bonds are not taxable to federal level, and federal bonds are not taxable to state level. Okay. Um, Interest exempt or tax exempt interest reported on the 1040 form, that is true. So that's the correct answer. Which of the following represents federal tax exempt obligation? Okay, so we're looking for, like I just said, if it's a state level, it's not taxable to federal. It's a federal, it's not taxable to state level. So we're looking at federal tax exempt. So anything issued at the state level or below is tax exempt. So that would make the first one, New York Power Works bond interest, tax exempt. All right. So although tax exempt for federal purposes, which interest might be taxable to the state's, to the taxpayer's state? Okay. So tax exempt for federal purposes. So that means that the state can tax it. Okay. And if it's state or below, it's exempt on the federal. Okay. That doesn't mean that the state can't tax it. Okay. So we're looking at municipal bonds because they're state or below. They are exempt from federal, but they're not exempt from state. Okay. Interest accumulating on an IRA must be reported each year on a taxpayer's return. That's not true. It doesn't matter. The IRS doesn't care about any interest in your IRA account until you start taking money out of it. Okay. So now we're looking at dividend. You guys are probably not going to see much in the realm of dividend income. It's just not something that a lot of our clients have, but we will go over it briefly here, okay? So dividends are distributions on um, some type of investment, okay? The taxpayer gives a corporation, let's just say, money and in exchange for a stock, okay? And the stock might be dividend producing, and so they get, maybe quarterly dividends or annual dividends, okay? And that comes on a 1099 DIV form. You do see them every once in a while, but they're not very common, at least with our clients, okay? So there are a couple different kinds of dividends. Um, there are ordinary dividends, there are qualified dividends, and they're taxed differently. Okay. We also have mutual funds, and what mutual funds are is there are a bunch of different stocks kind of in one uh, investment application. Okay, so you've got even fractions of shares owned in a mutual fund. Okay, it's not really there's not much that you deal with on mutual funds at all um, when you're actually doing the tax returns. All right, so don't worry about it too much. Capital gains is something that you deal with every once in a while. It's something that a senior preparer will definitely be available to help with. Um, there are uh, the main capital gain issue that you deal with. Well, there are two types. One is gains on stock transactions. Okay, so if you buy a stock at $10, you sell it at $12. That's a capital gain. Okay, but it can also be real property. Okay, it can be a home. If you buy a home for $100,000, you sell it for $120,000. That's a capital gain. A lot of times that's exempt because of certain tax laws, but that's what a capital gain is. Okay, you buy something at a lower dollar amount, you sell it at a higher dollar amount. Okay, non-dividend distributions. I'm not even going to worry about that. Okay, so this is the 1099 DIV form. We've got ordinary dividends listed up here. We've got qualified dividends listed in 1B, and then we've got total capital gain distribution in 2A. And we've got non-dividend distributions in box 3. Okay, but if when you pull up Profiler, you're actually going to see this form, and all you do is you take the information that's listed on the form that you have in front of you that your client gave you, put it into Profiler, and then Profiler basically does the work for you. Okay, so um, they must issue. Same thing with tax with interest. Essentially, it's just um, greater than or equal to. If someone receives dividends greater than or equal to $10, they will get one of these forms. But if they don't get one of these forms, let's say they got $9, that's still taxable and reportable. They just don't have the form for it. Okay. So then we've got different types of dividends here and where they end up on the 1040. That's not really applicable for us because Profiler, the tax software, takes care of it for you. Okay. All right. When a taxpayer buys part of a company, they get something called a share. So it's usually referred to as stock. So there's shares of stock. Okay. And the company may decide to pay an amount representing a portion of the company's profit or return on investment. These payments are known as, and those are dividends. Okay. Those are what you might receive quarterly or annually for your investment. Okay. A common type of mutual fund is a bank savings account, no. Money market fund, yes. IRA, no. Life insurance annuity, no. So we've got money market fund is a type of mutual fund. I don't know why that's really applicable here, but um, there it is. So when a mutual fund sells assets that were held for greater than 1 year, the distribution to the taxpayer is known as, and it doesn't really matter if it's a year or not, but if you sell something for less than what it was purchased for, that is a capital gain. Okay, so buy something for X, sell it at Y. As long as Y is greater than X, then that's a capital gain. Okay. All right. Qualified dividends are reported on line 3A of the 1040. Profiler is going to do that for you, so you don't have to worry about it aside from maybe this assessment. All right, so this talks about Schedule B. This is actually where the information is put onto the tax return. On Schedule B is what it's called, but Profiler does it for you. Okay, so for these purposes, for the purpose of filing a tax return, that's not much information you're going to need concerning the Schedule B. Okay, it's all going to be done for you by our software. All right, so now we've got a couple of more questions about Weldon. He received $450 in interest income plus $1,200 of ordinary dividends from sources inside the U.S. for the tax year. is Weldon required to file a Schedule B on his tax return? He's not, because um, he doesn't exceed the. You have to exceed $1,500 in dividend income in order to have to file a Schedule B form, okay, or Schedule B form. So the answer to that is no. You never have to worry about that when we're using Profiler, okay? So Jasmine received $1,275 interest from her bank account that she maintains in England from when she attended college. She also received $150 in ordinary dividends from sources inside the USA. Does she have to file a Schedule B form? She does in this case because she has a foreign bank account. Okay, so that the $1,500 doesn't apply if it's a foreign source. The government wants to make sure that they know where all your money is, um, especially when it's not inside the USA. All right, capital gains tax. Capital gains tax is something that's interesting and confusing. Okay, so a lot of times capital gains tax is actually 0%. Okay, which is odd. But the three tax categories they can fall into, or tax tables, is 0%, 15%, or 20%. Okay, and Profiler will figure this out for you. But just know that those are some of the tax amounts. Okay, so which ones? We just said this: 0, 15, or 20 is the correct answer. Which of the following is qualified? Which of the following qualified for reduced capital gains taxes? And that's qualified dividends. So those are listed on your 1099 DIV form in their own individual box. So they will be treated by our tax software differently just based on where you put them in. Okay, and like I said, you're basically copying exactly what's on the form in front of you onto Profiler, and it does the work for you. Okay, so we got a summary talking about basically what we just went over. For most taxpayers, investment income includes taxable interest, tax exempt interest, dividend income, and capital gain net income. Um, for most of our clients, we see taxable interest and a little bit of dividend income and a little bit of capital gains interest. I guess a little bit of all of them, but the most common one you'll see is taxable interest from like a savings account. People get like $10 or $100 or not very much, but that's what we see the most. Okay, and it talks about the 1099 INT form. The interest is in boxes 1 and 3. Schedule B here, but that's not anything we need to really worry about aside from this assessment. That it's greater than $1,500 or it's foreign sourced. Uh, the like I mentioned this at the beginning, credit unions often call their distributions dividends. They're actually interest. Okay, so that's just, people might say to you, I've got dividends from my credit union, but really we record it as interest. So keep that in mind. And then true dividends are distributions from a corporation. Okay. All right. There are a couple different kinds of dividends: ordinary dividends and qualified dividends. This goes into Schedule B a little bit more, and it talks about, goes over the bonds and everything that we did discuss. Okay. Okay. There are holding periods having to do with dividends. We don't need to worry about that. That never comes up. The capital gains of 0, 15, and 20% is good to know just so you can talk to people about it. But it's not something that you need to necessarily memorize for purposes of doing a tax return. And talks about the capital gains or dividends and capital gains worksheet, which Profiler does for you. Okay, so then there's the homework that can be downloaded from tax school. and then the assessment pops up next. And give me a moment here, and I'm going to switch over to the section. Okay, so the next one is retirement and government distributions. We touched on it briefly, talking about IRAs previously, but we're going to get into it a little more deeply here. Okay, so there are, well, I guess we're going to go over the objectives first. So there's a 1099-R form that I mentioned in the previous section that talks about distributions from an IRA account. Okay, so any retirement type of fund. Okay, so these can be either uh, distributions, qualified distributions, which are once a person hits a certain age, or they can be unqualified, where you just take money out um, because you need it, okay, for whatever reason. And so then you get different tax treatments based on whether they're qualified or unqualified. There are certain boxes, or there are certain codes in box 7 that go over the tax treatment of those on the 1099-R form. And as you enter those in the profiler, it figures out what needs to be done with that dollar amount. Okay. So these are the things that we're going to go over here. I'm not going to read through them all, but this is, we're going to be talking about pensions, annuities, and tax or retirement in general. Okay, so individual retirement arrangements. I mentioned that on the last one. That's what they are. That's what IRA stands for. And there are two different types. There are traditional IRAs and there are Roth IRAs. Okay, this goes over some of the differences of these two different types. Um, it's not This portion of it isn't, crucial to know, but they are different. The main thing are the tax treatments of the contributions and of the distributions, because they're handled two different ways. They are exact opposites of each other. Okay, so the traditional IRA is the most common. It says the most common IRA. Maybe that's true. Maybe that was true, but and only because traditional IRAs were the original IRA. Okay, when they came out with the Roth IRA, it's become incredibly popular. Okay, so they are treated differently, like I said. So the contributions to an IRA, a traditional IRA, may be deductible. Okay, and then the earnings are not taxed until they're distributed. Okay, so you're putting money in, you're not paying tax on it when you put it in, you're paying tax on it when you take it out. Okay, that's a traditional IRA. The Roth is the exact opposite of that. You pay tax on the income, and then you put it into your Roth IRA. It sits there, it accumulates interest, and then when you take it out, when you're of retirement age, ideally, then it's not taxed. Okay, so you get to put all this money aside, put whatever money aside you can afford, and whatever interest you gain on that, it's not taxable at the end, and that has, to me, huge. That's a huge advantage. Some people will argue different aspects of that, but that's the bare bones of it. Is traditional IRA, you put money in without being taxed on it, and then you're taxed when you take the money out. When you, for a Roth IRA, you're taxed on the money before you put it in, and then you're not taxed when you take it out. Okay, those are the two distinctions and the two types of IRAs. Okay, so there's going to be some talk about rollover. We do have rollovers. I'm not even going to talk about the tax-free withdrawals because they're not something we run across. Okay, but the rollovers you do see from time to time. So a rollover is when you take one type of retirement fund and you put it into another. Okay, so you're actually taking a distribution, but you're not taxing the distribution because you're putting it into another plan. Okay, that's the bare bones of it. This can only be done once per year. It has to be done within 60 days. So you take it out of one account, you put it into the other within 60 days. That's when you're covered. Okay. It has to be going from the same type of account to another of the same type, be, meaning if you're doing with traditional IRAs or any type of account, it has to be this tax treatment has to be the same. Tax treatment has to be the same in that case because it's you're either taxed on it when you put it in and not when you take it out, or not taxed when you put it in and taxed when you take it out. So if you flip from one to the other, there are tax implications. But if one account is the same in treatment as the other and you roll it from one to the other, then that's fine. There's no tax implications really. All right, so we've got a couple of examples here. Sasha received distribution from her traditional IRA on June 30th. She must complete the rollover contribution to her other traditional IRA by August 29th. That's 60 days from June 30th in order to be a distribution to be tax-free. Okay. Example 2 is Mike is expecting a big settlement in about a month, but he needs some money to take care of bills. He withdraws $4,000 from his traditional IRA to pay his bills. When he receives the settlement a month later, he puts $4,000 back into his traditional IRA. That's also tax free. Okay, I wouldn't advise that, um, unless it's guaranteed. But that is one thing that you could do. Okay, so taxpayers can make one tax-free IRA to IRA rollover per year. Okay, regardless of the number of IRAs you own. Um, it shouldn't really come up. I mean, it's good to know, but it won't come up in a tax preparation. Okay. Um, in addition to being subject to income tax on previously untaxed distribution, the taxpayer may be subject to a 10% additional tax uh, on the amount included in income and 6% additional tax for each year rolled over into the IRA. That's not something that we're gonna really. I mean, you don't you don't need to know that. There's 10% comes into play when people take out unqualified distributions. They're taxed uh, at ordinary income percentage, and then they have a 10% penalty on top of that. But I wouldn't worry about it when it comes to rollovers. Okay, you're not going to see people with multiple rollovers probably. If you do, reach out to a senior preparer, and they will help you with it. All right, so here is a couple of examples here. I'm just going to skip over to get to more important things that are pertinent to filing tax returns. All right, traditional IRA distributions may be fully or partly taxable depending on whether the IRA has any non-deductible contributions. So there can be non-deductible contributions, but again, I'm sorry, this it just doesn't really pertain to us. Okay. I'm going to just skip over this, and here we will talk briefly about, there's something called minimum required distributions. And if somebody has an IRA, um, and they hit the age 72 and they haven't started taking money out of it yet, they're required to take out um, a certain amount every year from then on, because the goal is to empty it out. Okay, that's what required minimum distribution. Some people do say RMD, but that's what they're talking about. It's literally a minimum distribution that's required to be taken out every year. Okay, so this talks about when that happens. This will all be reported on the 1099-R. I mean, it doesn't really matter that it's a minimum distribution. It shows up on the 1099-R here. Okay, so you've got gross distribution, taxable amount. This amount might be, there might not be anything in here. That doesn't mean it's not taxable. That means that the tax amount basically isn't determined yet. Okay, then we've got federal tax withheld in box 4, and that actually is when the company that manages the IRA takes the money out and puts it aside, sends it to the IRS for withholdings, just like on a paycheck. Okay, and then you've got your distribution codes in box 7, which tell you what type of distribution it is. Okay, so it can be normal, death, disability. There are multiple different kinds, and there's a code associated with each one. You select that in Profiler, and it does the automatic tax treatment for you. IRA, SEP, and Simple box, checked or unchecked. You just transfer that information to Profiler, and it is handled without you having to worry about it. Here are the distribution codes. Okay, it's not terribly necessary for you to memorize these. They are helpful to know, but it's not crucial because all you're doing is taking the information from the 1099-R form and putting it into this box, or well, you'll see this box in Profiler. Okay, so you take it from the form you're holding, put it into the box in Profiler, and it is handled. Okay, so this talks about where things go on the 1040. Again, not too concerned about that because Profiler handles that for you. This has an illustration of from taking it from the 1099-R and putting it onto the 1040. Again, Profiler does that. So Roth IRAs. These are the ones that you pay the tax up front, and then you don't have to pay tax on it when you take the money out, as long as you hit 59 and a half. That's retirement age for a Roth IRA. Okay. Roth IRAs do not require any minimum distributions. Those are only traditional IRAs. Um, and this is just kind of an overview, you know, of IRAs, but nothing of it really has anything to do with filing taxes. So, a qualified distribution from an IRA, Roth IRA, must meet two requirements. Distribution made after a 5-year waiting period, beginning of the first taxable year, which contribution is made to the Roth IRA. And then the main thing is that um, the that you've reached 59 and a half. Okay. Um, it could also be because of the taxpayer is disabled. It could be to a beneficiary upon the death of the taxpayer. And then you can also use $10,000 in your lifetime as a first-time home buyer exemption for, a down payment on a house. Distributions from a Roth IRA that is not taxed or not qualified distribution may be partly taxable. There's also, in all likelihood, a penalty for taking that out. Okay. Um, okay. So you can borrow from IRAs and pay it back. That's an option too. But and you might see some of that because of COVID. There were a lot of people that took money out of their IRA as a loan. They do have to be paying that stuff back, otherwise it becomes taxable. And I don't know how much of that we'll see this year because I don't know how many people really took advantage of it last year. But there are, this talks about distributions and rollovers. Um, and then there is conversions. If you convert from a traditional IRA to a Roth IRA, it's it can be taxed, okay, because you can't get both sides, you can't get benefits of both sides, okay. So um, you need to that will be something that may come up, but it's very unlikely that you'll see it, okay. All right, so then there's some other conversion methods listed here. I'm not going to go into those because I need to get stuff that is more applicable for actually filing tax return. This just shows, what's happening on the 1040 and um, the Form 8606, but that's all handled by Profiler. Okay, so Roth IRA rollovers from a qualified plan. These are the types of qualified plans you can roll into a Roth IRA. And then this talks about reporting distributions, okay? But all this stuff is handled by Profiler. I'm sorry that I say that so much, but I don't want to bog you down with things that you don't really have to worry about. I want to put your mind at ease about things that may seem complex, challenging, and let you know that our software is very good. If you just trust the software, uh, it'll get you the right result. Okay. So I'm going to skip over this illustration. This indicate whether or not this is information is taxable, or this transaction is taxable or not. So qualified distribution from the Roth IRA, that is not taxable. Roth distribution is properly rolled over into another Roth within 60 days. That's not taxable. Qualified employer plan distribution that is not a return of after-tax contributions and is properly rolled into a Roth IRA within 60 days. That one's actually taxable because you can't get benefits of both sides. Okay. Traditional IRA distribution that is properly rolled over into another traditional IRA within 60 days, that is not taxable. Qualified employer plan distribution that is properly rolled into a traditional IRA within 60 days, that's not taxable because it's going from the same type of account into the same type of account as far as tax purposes go. Okay. So there are the answers there. These talks about pension and annuity plans. There are a couple different types of pensions and annuity plans. They are either represented on the 1099-R form as a pension, or they can be a couple of different types for annuities, which are generally either a government-sponsored program, being like a government employee, or railroad retirement. And that's something that you may run across during tax preparation. Okay, so this talks about what annuities are and what pension and annuity payments. I'm more interested in getting to the portion where it talks about the forms that they come on, because if you just follow the form, it will get you to the right result. Okay. This talks about more rollovers. They're essentially treated you know the same. Uh, Now this is concerning early distribution. Okay, so they are when you're taking an early distribution, the plan administrator, the company that handles the plan, they're required by law to take 20% withholding. Okay, that may or may not cover the entire amount. Okay, so some people will say to you, yes, I took money out of my retirement account, but they already took the taxes. Well, that may cover them, but it may not, because there's a 10% penalty involved. They may be covered because their income is at 10%, or their tax bracket's at 10%, but it doesn't necessarily mean that they're fully covered. Okay, but that is a requirement that the plan administrator must withhold $2,000 or 20% of the distribution. Okay, so in this example, Tom took an early distribution of $10,000, so they had to withhold $2,000 for federal taxes, and he only got $8,000. Okay, so here's some rollover rules that determine the tax treatment of these items. This goes over payments and rollovers, but this stuff doesn't really come up when you're actually doing a tax return. It talks about where it goes on the 1040, but as long as you take it from the 1099-R and put it in the profiler, that is handled for you. This gives you an example of the 1099-R. This is an illustration, but it shows, it's the same as what we were looking at before. It's just talking about pensions and annuities, but it comes on the same form as an IRA distribution or 401k distribution. Okay, so again, it's talking about the form. So we've got on this one, it does say gross distribution of $12,000 and taxable amount of $12,000. Again, that might be blank, okay, but when you put the information in a profiler, it will determine the taxable amount. So then this one shows a gross distribution of $14,400 that this person took, and there's an employee contribution amount of $31,000 here. So what it's doing is it's showing where the money came from, essentially, and there's different tax treatments based on that. But as long as you follow Profiler and put that information in, it will determine the correct tax treatment of that for you and actually do these steps. Okay. I'm sorry that it seems like I'm glossing over a lot of this. Again, I just want to put your mind at ease and let you know that a lot of this seems complicated, but when actually doing the tax returns, you just put the information in and it takes care of it for you. Okay. So this talks about disability distribution reporting. It's very unlikely you're going to come across that. However, just follow the form and you'll be in good shape. Okay. So this is just an illustration of that one and how that's treated on the 1040. All right. So I've actually been waiting to get to this one. So these are a couple of different types of pensions or annuities, and the one that I really want to focus on here is the railroad retirement, okay, because that one can be a little complex. They actually get two different forms for railroad retirement, and they look very similar, but you have to add both of them, okay? There's, I think, a blue one and a green one when they come in. Keep an eye out for that, okay? Those tend to happen more on the east side of Michigan. In our three locations over there, there are some railroad retirees that come to us, but it can't happen in any of our locations. But just keep that in mind. All right, so the CSA is Civil Service Annuity. So this is a government um, plan that Office of Personnel Management is what it's going to be paid by right here. And again, it's just a specific form. You follow it, put it in the profiler, and you'll be in good shape. Okay. So this just shows an illustration of that and with the distribution and what it all looks like. Okay. So we've got starting to talk about state information now. Okay. So there is, state tax on some of these things. And this just shows you from the form here in the profiler that you would be none, obviously, if it's blank, okay? And this goes on to what happens on the 1040, but that's all handled in profiler for you. Okay, so then here's the RRB 1099. So this is the railroad retirement board, and it shows the form here. This is the RRB 1099R form. So you just enter this information in profiler. It handles everything for you. This shows you kind of where, because the forms look a little bit different, right? Here, I'm going to go back to the last one. So this is what it looks like on the RRB 1099, and then how it gets translated over the 1099R form. Okay. And this is the 1040, so we don't need to worry about that. So knowledge check, it's going to ask, using this form, it's going to ask you questions after this. Okay, so we've got, just keep in mind we got a gross distribution here of 5487, and then we got a distribution code of G. Okay, and that's what the next question is going to be. So, which of the following is true? Well, that's kind of a hard for anyone to determine based on just looking at the forms. But the 1099, excuse me, code G. Let me regather myself. Code G in box 7 stands for direct rollover. Okay, so that would be a non-taxable distribution. All right. And then we've got, which of the following is reported on the wages line of the 1040. We've got, okay, so it's saying these are all distributions. Which of these 4 are reported on the wages line? That would be taxable disability benefits. And I don't think, I mean, that's something that you're going to need to know when you're sitting doing a tax return. So, Zed received a $10,000 early distribution from his pension plan, and 20% was withheld for federal tax. He received a check for $8,000. How much must Zed roll over into a qualified plan within 60 days in order for the amount to be non-taxable? And that would be $10,000. Okay. Um, he'd have to, unfortunately, um, so there's 2 different ways that you can make a distribution. Okay. You could take money out and they're going to say, is this for a rollover? And you say yes, and then they can do a direct rollover, and you wouldn't have to worry about this aspect of it. But this case, he took an early distribution, and they took withholdings. Early distribution was for $10,000. He would have to put $10,000 into another account, even though they took $2,000 away from him. So he'd have to make up the other $2,000 somehow, some way, in order to make it non-taxable. That's not something you're going to come across, but it is kind of interesting to know. All right, Joan began receiving retirement benefits under joint and survivor annuity starting January 1 of the tax year. The benefits are to be paid for the joint lives of Joan and her husband, Juan. Both of them were 65 on the annuity date. Oh, geez. You have to actually use the simplified method worksheet to do this. We're going to skip this one because we're not going to do that. Profiler does that for you. So this shows you the actual how you would come up with the answer to that one. All right, the Social Security benefits. You do come across this quite often. Social Security benefits are listed on a statement called the SSA 1099 form. It looks like this, a very, very simple form. One of my favorite forms because it's so incredibly simple. It's got the benefits amounts here, anything repaid, usually this is blank, and then the net benefits here. It does also list the Medicare premiums over here, okay? So, all right, so taxpayers whose income is only Social Security generally are not taxable, or they're not required to file a tax return because they're not taxable, okay? Taxpayers with income in addition to Social Security may be required to file a tax return and include Social Security. Social Security benefits can be taxable depending on your other income. Okay, so only the benefits reported on Jeffrey's. So Jeffrey and his daughter Doris, Jeffrey, and Doris each receive separate SSA 1099 forms in their names. Okay, only the benefits reported on Jeffrey's SSA 1099 are used to determine whether any of the benefits are taxable to him, and the same goes for Doris. Even if the check for Doris's benefit is made out in Jeffrey's name, this is still Doris's benefits and taxable only to her, not Jeffrey. So that is something you may run across. Just know that when you're looking at the SSA 1099 form, that the individual's name listed here, that is the taxable party. Okay, it doesn't matter who the payment went to. That information in box 1 is who the taxable party is, and obviously accompanied by the Social Security number of the individual there. All right, so this is talking about calculating the taxable amount of Social Security. That's not necessarily pertinent because Profiler does it for you. You do need to know that Social Security, if it is taxable, it's either taxable at the at 50% or 85%. Okay, those are the two different tax brackets for Social Security, and this shows you the thresholds for that. Okay, so um, you know the highest end of the Social Security tax would be taxing 85% of the benefit. Doesn't mean they're taxed at 85%. 85% of their benefits or 50% of their benefits are taxed. Okay, not, they don't take half away. It's just that the taxable amount, the rest is tax free. And that's a little bit confusing, but um, Profiler will help you through that, just like everything else. All right, so this goes into an illustration where it talks about, it gives this scenario, okay, and it's going to ask basically, what is taxable, okay, and on here with that scenario, you look at all the information. So these are the other pieces of the income aside from their Social Security, and because they fall below the 32,000, none of their Social Security is taxable at all. So it's entirely tax free. Okay. All right. So here's another scenario. I'm not going to read through it all, but so his taxable pension is above the base amount of $25,000 for single taxpayer. So some of his Social Security benefits are going to be taxable. Okay, and that's all handled on the Social Security benefits worksheet, which is here. But again, this is all handled by our software. Okay, so sorry, I'm just checking the time. These are the filing requirements, which we went over, in maybe, I don't know, session 1, but it shows them here. These are actually quite old, so there's more up to date information than this, but it kind of gives you, reminds you of the tax benefit or tax requirements. Okay, when you need to file a tax return, I guess, but those numbers are actually out of date. Let's see. Gross income for filing purposes does not include Social Security benefits unless either of the following applies. Taxpayer is married, filing a separate return, and live with their spouse at any time during the year, or half of the taxpayer's Social Security benefits plus their other gross income and tax-exempt interest are greater than $25,000 for a single individual or $32,000 for married filing jointly. Okay, so those are the times when Social Security benefits are included in gross income. So this gives an example of that. Well, no, it's an example of just if they need to file or not. So they're married filing jointly. Basically, you add all this up, and if you're not including Social Security benefits in here, then they fall under the threshold and they don't have to file. Here's one where the taxpayer does have to file and some of his Social Security benefits are taxable. And this goes over the worksheet to get there. Sorry, I'm distracted thinking about finishing this up. Okay, so it talks about the 1040. Don't worry about that because this is handled by Profiler. Again, sorry, I should have deleted this stuff. So take a look at this. We've got a couple of pieces of information that may be pertinent here for the following questions. Okay, wish they would show both slides at once. Let's try to memorize what they're saying on this one. 6130 in benefits. Taxable pension 86 or 18.6. Wages for part-time job 9.4. 990 taxable interest. Total is 28.99. 28,990. I apologize. What amount is entered on Social Security benefits? That's the 6130 that was listed on the 1040 form. Okay, now unemployment compensation. This one's important. Okay, so um, you're going to see unemployment. That's for sure. Okay, there are people with unemployment out there. They get a form called a 1099-G form. Okay, it's entered just like any of the other forms. Uh, Quite simple, in fact. Um, and be aware that they are going to be out there for sure. You'll definitely encounter them. All right, so it's got unemployment. It's just like a 1099-R form. It's just that the boxes are a little bit different. Okay, but it's very straightforward. Okay, so we've got the unemployment compensation listed here, the federal income tax withheld listed here. You also have your state information down here. Okay, it also can have like repayments and that kind of thing. Um, those are a lot less common, but they are out there. All right, so this shows where it goes on the 1040 form, or excuse me, the Schedule 1, and then it flows onto the 1040 form. Um, we're not going to worry about that because Profiler does it for us. All right, how much is Samuel's total unemployment compensation? That is listed right here. Okay, so 5642 is the correct answer there. All right, yes, we made it to the summary. Okay, so we are. I'm sorry, I'm trying to get you guys out of here in under an hour, and I didn't do it. So there's a summary of the rules for receiving distributions from a traditional IRA. This is just obviously is a summary, so it's stuff that we already went over. Okay, but you will want to, just like in my other videos that I've had, when you go in to do the assessment, I'm going to jump to that part. You can log into Tax School, go to this section, jump down to assessment. When you start taking the assessment, go up to resources in the top right hand corner. And I'm sorry, I wish I had. Wait, do I? I might have a. I might have a tax school. Yeah. Here we go. Okay, so I do have a tax school open. Okay, so go up to resources right here. Click on resources. Go to participants manual, and this gives you all the information that was presented to you uh, in the original, well, in this section. Okay, so you can easily go through here while you're within the assessment and look up answers. Okay, if you guys have any questions, concerns, need help with anything, please reach out to me. You can reach me at 616-600-4340. I am happy to help anytime you guys need anything. That's what I'm here for. Okay, so take care. I hope you enjoyed this session, and I look forward to working with you. All right, thanks. Bye.